If you have just started your investment journey, then you might have heard of terms like CAGR, NAV, PE ratio, and you might have felt a bit confused. If it is the case, then this video is just for you, because in this video I am going to break down these concepts into simplest way. So if you are new to my channel, my name is Aman, and in my channel I break down financial concepts into simplest way possible. So if you are someone who is interested in finance or wants to learn more about the topic, then I believe that this channel might help you. Well, without wasting any further time, let's just start today's video. We have quite a number of terms, so we will be dividing this video into two parts. So firstly, let's just begin with CAGR, or compounded annual growth rate. So it tells us the annual growth rate of return for a particular period, and it assumes that the profit is being reinvested every year. So CAGR basically removes the volatility, and it tells us the true average growth rate. Now, for example, if I invested 1 lakh and it became 2 lakh in 5 years, then if I want to find what is CAGR, then a formula is being implemented, which is ending value by beginning value to the power 1 by n minus 1. With the help of this formula, we can denote the CAGR, and the best use for CAGR is to compare the stock prices of the mutual fund to find out which is an attractive option. Second, we move on to NAV, or net asset value. So NAV is a valuation metric for mutual fund. It tells us the price per unit of mutual fund. People have a common misconception that a higher NAV means better performance. Well, a lot of things needs to be taken into consideration, be it how the fund is been performing in the past few years, how the other funds are performing in that same category, or who is the mutual fund manager. Well, NAV is denoted by a formula which is total assets minus total liabilities by number of units. And third are REITs, or real estate investment trust. So they are the companies which owns, operate, or finance in income generating real estate. For example, hotels, shopping mall, resorts, and they are just like mutual fund, but they are directed towards the property investment. Now, one of the major benefit of REITs is that it has a lower entry cost. Second, it also provides diversification in the portfolio for those investors who wants to gain a real estate exposure. And third, investors can also earn the dividend in the form of rents. Some of the few notable real estate investment trusts in India are Embassy and Mindspace. Fourth are ETF, or exchange traded funds. So they are the collection of stock, bonds, and commodities, and they are traded exactly like a stock on an exchange. One of the major features of ETF is that they are diversified just like mutual fund. Now, secondly is that they are liquid in nature, as a result of which we can buy or sell them like a stock, and they generally have lower expense ratios. Now, ETF are generally risky because it can go down along with market fluctuations. Now, fifth and the most trendiest word in today's day and age is SIP, or systematic investment plan. So it is a disciplined way of investing in mutual fund by contributing a fixed amount of income regularly at a certain intervals. Now, few benefit of SIP is that it builds a habit of investing. Now, second, it enables the investors to experience the power of compounding, because we are investing in the market irrespective of the market conditions. And third is that it is always advisable to invest in mutual fund for the longer duration in order to gain certain benefits. And it is also advisable to increase your SIP as your income grows. So lastly, to summarize, in our today's video we have covered the first 5 terms which every investor should must know, which is CAGR, NAV, REIT, SIP, and ETF. And I know that you might not have gained a full understanding in detail, but I'm sure that you must have gained a little bit of idea. Now I'll be coming with the part 2 of this video soon. Till then, see ya, stay tuned, keep learning.